Hello all, welcome to Get Into IAS, and in this video we are going to deal with the chapter Indian Financial System and specifically Money Market. So next, moving into the direct action, that is the RBI issues policy decisions. What the RBI will do is, it will tell the scheduled banks to send proposals of loans and those will be scrutinized. For example, see, if any scheduled bank is giving a loan of rupees 1 crore to a person, what RBI will do is, before he could lend this 1 crore rupees to this person, RBI will tell this respected scheduled bank to send proposals. That is, already if this person has taken loan, if he had repaid the principal and interest on time, so he has to jot this down. This scheduled bank has to jot everything down and send that proposal to RBI. Then it will give a decision whether to give this 1 crore rupees to this person or not. That is, it will basically scrutinize this loan sanction. Fine. Next, moving to moral suasion, it is a request, suggestion or advice given by the central bank to the commercial banks. Fine. So it is the request, suggestion and advice. So it will tell what are the do's and don'ts in the banking system. So normally the commercial banks will meet with the RBI and they will decide the suggestions and advice given by the RBI. This is called as moral suasion. Next, moving to publicity. Publicity means it's a publication. Publication done weekly or monthly in a website, fine, a website or any portal regarding the assets and liabilities. I already told you all about the balance sheet of a bank. So balance sheet contains the assets and the liabilities. So all this will be publicly given to the people through the websites. So by this you can bring in transparency. Transparency in the sense how much assets are there with the bank, how much liabilities are there, how much non-performing assets are there. All this is calculated by using the publicity. Next, moving to the composition of money market. So the money market comprises of two subheadings. One is the organized sector, another one is the unorganized sector. Under the organized sector, you have the banking and submarkets. Very important. Look at this. Under the organized sector in the money market, you have the banking and submarket. Under the banking, you already know the banking's proposals. That is, the deposits will be taken from the people and the lending activity. Credit creation is done by the banks. Under the submarkets, the money transaction is taken place within the banks. See, bank will lend to bank 1, will lend to bank 2. So this is the transaction, money transaction taking place between two different banks. That is called as submarkets. Fine. Now moving to the banking. So under banking, you have the commercial banks, the regional rural banks and the cooperative banks. We'll deal each one separately. Now moving to the commercial banks. Under commercial banks, you have the public sector bank and the private sector bank. So under the public sector bank, you are going to deal with State Bank of India and its groupings. And next one, other nationalized banks you are going to deal with. Next, moving to private sector. Under the private sector, you have the Indian banks, which is privately owned, and the foreign banks, that is also privately owned in India. Next, first one, coming to the commercial bank. We are dealing with the commercial bank. Fine. So under the commercial banks, the deposits and the loans, there are two kinds of things, right? Deposits and the loans are both done in the commercial way, that is the profit motive. So the commercial banks, the main motive is profit. Next, it is regulated. The commercial banks is regulated under the Banking Regulation Act of 1949. Next, moving to the public sector banks. So we've done with the, under the commercial banks, we are moving to the public sector banks. So under the public sector bank, the first one is the State Bank and its group. See, under the public sector bank, majority ownership is taken by the government. The government holds the majority of the ownership. So under 100%, 51% is owned by the government. That is why it is called as public sector bank. See, normally all the banks were not public sector banks, okay? Earlier it was private bank. This private bank, through nationalization, it became a public bank. Fine. So earlier, when it was a private bank, through nationalization, it became a public bank. Now moving to the first set, that is the first public sector bank, it is the State Bank of India. So under State Bank of India, it was earlier called as Imperial Bank of India, and in 1921, what happened was, three banks were merged under this Imperial Bank of India. First one is the Bank of Bengal, in 1806 it was created, and next one Bank of Bombay, 1840 it was created, and lastly the Bank of Madras, 1843 it was created. So all these three banks were merged to form the Imperial Bank of India. Fine, in 1921 only it was merged. This is the year of formation of the respective banks. See, the Imperial Bank of India was partially nationalized on July 1, 1955. So after our independence, this Imperial Bank was partially what? Nationalized, given to the government and renamed as State Bank of India. And later in 1955 only, this Imperial Bank became what? SBI, State Bank of India in 1955. Okay, got the point? And in 1959, 8 banks of former princely states were bought under the SBI and its associates. See, in 1959, what happened? 8 other banks was merged with this SBI. What are the 8 banks? The State Bank of Bikaner, State Bank of Jaipur, State Bank of Hyderabad, State Bank of Indore, State Bank of Mysore, State Bank of Saurashtra, State Bank of Patiala, State Bank of Travancore. So all these banks was merged together into the SBI. Next, among these banks, State Bank of Bikaner and State Bank of Jaipur were merged together and called the State Bank of Bikaner and Jaipur. So before it could be merged with SBI, earlier this Bikaner and Jaipur was merged and called as State Bank of Bikaner and Jaipur. State Bank of Saurashtra and State Bank of Indore were merged with the parent bank State Bank of India. So next merging took place like State Bank of Saurashtra and Indore was merged with SBI. Next, on April 1, 2017, recently, all associate banks and Bharatiya Mahila Bank were merged with SBI. So, this bank called as associate banks, that is the associated bank of SBI, and the Bharatiya Mahila Bank was merged with SBI. SBI is the largest public sector bank in the country. Very important thing to be noted down. Which is the largest public sector bank? It is SBI. Next, SBI is the, previously major part of SBI share was held by RBI. See, I told you the banks have certain percentage of shares. Earlier, this SBI had a large amount of share, that is RBI had large amount of share with SBI, but to reduce the RBI's work, okay, see it's given here, to endow RBI with only the regulatory functions and to unhold its administrative work. So, keeping a share with the SBI increases the administrative work of RBI and hence RBI was taken away from this share to increase its what? Regulatory work. RBI's main function is regulation and not administrative work. So, it was taken away from the share. So, RBI shareholding was transferred to the Government of India. So, this is how the share went from RBI to Government of India. That's why it is called as a public sector bank. Fine. Next one, other nationalized banks. So, under this, before nationalization, many banks were in the urban area. So, before nationalization could take place, many banks were in the urban area. There were some banks in the rural areas also, but it was only used for the deposits and not for credit creation. And if the banks were in the urban areas also, it was like mainly owned by the rich people. What those people used to do is, they used to get all the deposits from outside, club in and use that money for themselves. So, this is how the banks was regulated in both urban and the rural area. Later, the government came in, took place a major role and nationalized most of the banks. So, this is how the nationalization of banks took place. So, the nationalization of banks took place under 2 stages. We'll see about the 2 stages now. See, on July 19, 1969, 14 large commercial banks which had reserves of more than 50 crore were first nationalized. 14 banks, large commercial banks was nationalized. So, what was the reserves that they had? More than 50 crores. Fine. So, what was those 14 banks? First one is the Central Bank of India, Bank of India, Punjab National Bank, Canara Bank, United Commercial Bank, Syndicate Bank, Bank of Baroda, United Bank of India, Dena Bank, Allahabad Bank, Indian Bank, Indian Overseas Bank, Bank of Maharashtra. Fine. So, all these 14 large commercial banks were nationalized on July 19, 1969. So, secondly, this was the first nationalization. Secondly, 6 banks were nationalized on April 15, 1980. So, you have to get the point. First was done in 1969. Second, it is being done at 1980. Had reserves of more than 200 crore. So, first more than 50 crore. Second nationalization took place of more than 200 crore. So, what are the 6 banks? First is the Andhra Bank, Punjab and Sindh Bank, New Bank of India, Vijaya Bank, Corporation Bank, Oriental Bank of Commerce. So, in September 1993, New Bank of India was merged with Punjab National Bank. So, this New Bank of India what we saw now was merged with whom? Punjab National Bank. Then the total of nationalized bank came to be 19. So, totally in 1993, the total amount of nationalized bank turned to be 19. First, it was 14 banks which was nationalized. After that, 6. After that, totally 19 banks was nationalized. Fine. Dina Bank and Vijaya Bank was merged with Bank of Baroda. So there were two banks, that is the Dina Bank and the Vijaya Bank. These two banks were merged with whom? The Bank of Baroda in April 1, 2019. Then now the total number of nationalized banks is 17. So how much banks we have now nationalized bank? 17. So you have to keep this number in mind. Total number of national banks at present is 17. So next moving to the public sector banks. So next moving to the public sector banks, under this the IDBI was a financial institution, later it was changed into a bank. Next one is the India Post Payments Bank, which was set up in 2018 in New Delhi, that was changed to a bank. So under this bank, that is the India Post Payments Bank, 100% of stake is owned by the central government. Next, coming to the total amount of PSBs in India, there are 20 PSBs in India right now, including the State Bank of India, the IPPB and then the IDBI. So I told you earlier there were 17 PSBs, and now adding to the SBI and IBPP and IDBI, we have totally 20 public sector banks. Now moving to the private sector banks. Under private sector banks, we have the Indian Private Sector Bank and the Foreign Private Sector Bank. So under the Indian Private Sector Bank, we have the old Indian Private Sector Bank and the new Indian Private Sector Bank. So what are these old? So if the banks was set up before 1990s, it is called as old private sector bank. If it was set up after 1990s, it is called as new private sector bank. This differentiation is for the comparison between the banks. That is, how was the old and how is the new performing now. Next, under the new private sector banks also, we have the small banks and the payment banks. Very important for prelims. Already the UPSC questions on prelims was reflected on the small banks and the payment banks. So these two banks, that is a small bank and the payments banks, are referred as differentiated banks by the RBI. So these two banks are called as differentiated banks. They differ from the banking system slightly. See, now let's deal with the small banks. See, small banks accept deposits and lend money. Fine, like normally the banking system. So these small banks are set up under the unserved and the underserved areas. See, many rural areas doesn't have banking system, right? So they are unserved. Or if it is underserved, even if the banks are present, they are not doing the banking activities like deposits and lending, taking deposits and lending activities. So on those places, these small banks will be set up. Fine. So the small banks will lend loan to small business, small and marginal farmers, MSMEs, micro, small and medium enterprises, and the unorganized entities. So in the unserved and the underserved areas. So 75% of the credit should be to the priority sector. So under this priority sector only, all these agriculture, MSMEs will come in. So the small bank, if it is having 100% capital, 75% should be lent to the priority sector like agriculture and MSMEs. Fine. Okay. Next, moving to the payment bank. We have done with small bank, now payment bank. So payment bank also will accept deposits. So it will accept deposits of the individual's small business. So maximum deposit the individual or the small business can deposit is 1 lakh. So if I am going and depositing in a payment bank, I can deposit maximum only 1 lakh. Fine. It will not take deposits from the NRI. So non-resident Indians. So it will not take deposits from those people. Only who are resident of India, those people only can go deposit in the payment bank. Next, this payment bank will issue ATM and debit card but not credit card. So this was a previous year UPSC question. Fine. It will not issue what? Credit card, but it will issue what? Debit card. Fine. Next, this payment bank is set up in the remote areas. So remote areas, this payment bank will be set up by its own branch. See, you take KVB bank, okay. So this bank has a subsidiary. So that own branch will be set up in a remote area or through the business correspondent. See, in some rural areas or the underserved or unreserved areas, you can't set up a bank. Fine, you won't have the technological and the infrastructure to set up in that area. So hence you will send a business corporate to that area to take forward the banking activities. He will go in place of the bank and take forward the deposit and lending activities. So this is called as what? The payment bank. Now moving to local area bank. So what is a local area bank? See, under this, the backward and less developed districts are taken into account. So in those areas, the local area bank is being set up. So it is set up for the local credit creation. So what is this local area bank set up? For the local credit creation in that area using the resources of that area itself. Next one, This local area bank is registered under the Companies Act of 1956. So under what? This is very important for prelims. It is registered under the Companies Act of 1956. See, in case if tomorrow I am setting up a company, I should register it somewhere, right? Same way, if you are setting up a local area bank, you should register it under the Companies Act of 1956. Next, the capital to set up local area bank is 5 crore. 5 crore is the capital, and the promoter should contribute how much? 2 crore. Next, it is regulated. Local area banks is regulated under the RBI Act of 1934, Banking Regulation Act of 1949 and the RRB Act of 1976. So, under all these, it is being regulated. It is not only regulated under RBI Act of 1934, you have to keep it in mind the other two acts also. Next, moving to the foreign private bank. Foreign private bank is like, see, after the LPG reforms in 1991, we opened our economy. Before that, our economy was a closed economy. We didn't let any people from outside entering our country and doing business here. And later what happened? In 1991, we had a reserve crunch. Fine. We had the foreign exchange reserves to be very low. So, we opened the gates for the companies to come inside. Then came the foreign private banks to India. So, after 1991, the economic reforms let the foreign private banks come in. So, the city banks, the Barclays was set up in India. Same way how foreign private banks are in India. So, same way the Indian banks are set up abroad, right? It can be public or private. The government can set up in abroad country, or the private from here can go set up in an abroad country. For example, in Bahamas, in Cayman, Channel, Mauritius, you have the Indian banks, that is both the public and the private banks being set up there. So now moving to the classification of banks, we have two kinds of banks, that is the scheduled banks and the non-scheduled banks. Fine. We have RRBs and the cooperative banks also. I am letting you know the major classifications, that is the scheduled banks. Scheduled banks, why it is called as scheduled banks? Because it is listed under the Schedule 2 of the RBI Act of 1934. That is why it is called as the scheduled banks. See, the paid up capital and the collected fund of the bank should not be less than 5 lakh. So, how will a bank be called as a scheduled bank? The paid up capital, the total capital and the funds, the deposit that the bank has got should not be less than 5 lakh. That is, should be more than 5 lakhs. And then the activity of the bank should not affect the interest of the depositors. See, if I am going and depositing to a bank, my interest should not be affected. So, if these two conditions are satisfied, it will come under the scheduled bank. If these two conditions are not satisfied, RBI will delist it from the scheduled bank condition. That is, it will deschedule the bank from the Schedule 2 of the RBI Act of 1934. What is called as a non-scheduled bank? See, under the scheduled bank, these banks are eligible to obtain loan from RBI. So, these banks will obtain loan from RBI. So, what is a non-scheduled bank next? So, this non-scheduled bank is not listed under the Schedule 2 of the RBI Act of 1934. That is why it is called as non-scheduled banks. This non-scheduled bank should also maintain the cash reserve ratio. Cash reserve ratio means the bank should deposit certain amount of money to RBI. But this bank should maintain CRR but within themselves. They no need to deposit that with the RBI. See, normally the banks will deposit CRR with the RBI. But this non-scheduled banks need not deposit this CRR amount with RBI. Instead, they can keep it with themselves. Fine. And they are not eligible to get loans from RBI. Who? The non-scheduled banks, they are not eligible to get loans from RBI. But under emergency situations, they are eligible to get loans from RBI. Normally, they are not eligible. Next, moving to the Regional Rural Bank, it was set up in 1975 under the RRB Act of 1976. Fine. Next one, 6 states except Sikkim and Goa have RRBs. So, except Sikkim and Goa, the 6 states have what? RRBs, Regional Rural Banks. See, for example, there is a condition called a sponsor bank. For example, if there is SBI, SBI should contribute certain amount to set up RRB. So, SBI is a sponsor bank. Fine. So, the main bank is called as the sponsor bank. So, for what is this RRB setup? This RRB is set up to increase the credit flow to rural areas. So, rural areas lack credit flow, right? So, that's why regional rural banks was set up. So, it gives credit to the weaker sections. Those are called as target groups. Who are the weaker sections here? For example, the landless laborers, artisans, craftsmen, all these people are provided with loans at concessional rates. See, for normal people, if I am going and approaching the banks, for me interest rate will be 10%. But if they are landless laborers, artisans, craftsmen, if they come under the target group, for them the Interest percentage will only be 5%. So this is how the RRB will extend its credit to the rural areas. Next one, from 1997, the RRBs were freed to lend outside. So earlier, before 1997, RRBs lent only to the target groups. Fine. After that, they were freed from lending only to the target groups, and now they are lending to everyone. Fine. In April 1987, there is a committee called as Educator committee. This committee recommended no new RRBs. Why? Because they were less profitable. So the RRB set up in the 6 states, they didn't make up so much profit. That's why it was less profitable, and hence under the recommendation of the Educator committee, no new RRBs were set up after that. Fine. Next, moving to the cooperative banks. The cooperative banks was established by the state laws. So there are various state laws. By the state laws only the cooperative banks were established. They have the stakeholders. For example, see, if 3 people come together, they have money, they are rich people, they come together, they pool in their money together and form a bank. That is called as cooperative bank. Fine. So there is a stakeholder. Stakeholder in the sense is person 1, person 2, person 3. All these people are the stakeholders in the cooperative banks. And next one, normally the funding is done for agriculture and allied sectors plus village and cottage industries. So to whom does these cooperative banks lend to? Funding agriculture, allied sectors, village and cottage industries. Next, they do both lending and depositing activities. That is, they take deposits and they do the lending activities also. Next one, coming to the voting, it has 1 person, 1 vote. For example, if they are taking any decision to give loans to a certain person or people or a certain group or agriculture or any sector, the weightage of the decision is 1 person, 1 vote. In case if there are 4 people who has formed the cooperative bank, each people has only 1 vote. So the major decision, if 3 people supports for the decision, it will be passed on. If only 2 people and 2 people has been accepting, there is a tie. So this is how the cooperative banks will work. Next one, NABARD. So NABARD is the apex body of cooperative sector in India. So National Bank for Agriculture and Rural Development. So that is called as NABARD. So NABARD is what? The apex body for the cooperative sector in India. So now let's move into NABARD. So NABARD is the National Bank on Agriculture and Rural Development. So that is called as NABARD or National Bank. So before NABARD could come, the financing agriculture plus refinancing of cooperative banks. What is refinancing of cooperative banks? See, cooperative banks might not have money. So if certain schemes has to be established, for example, RBI will refinance to the cooperative banks. So I'll let you know about the refinancing. See, if cooperative bank has to lend to person 1, it will not use its own money to lend to that person. Instead, it will get money from RBI and then lend to this person. This is called as refinancing. Not using its own money. Instead, it will use another bank's money to finance this person. That is called as refinancing. So, refinancing of cooperative banks plus RRBs was done by Agriculture Refinance Development Corporation of RBI. So, this is a branch of the RBI. That is Agricultural Refinance Development Corporation. So, this was carrying out the activities like financing agriculture, refinancing of cooperative banks plus RRBs. Later, these activities was taken by whom? Was taken care by NABARD. NABARD was established in July 1982 and later all these functions was carried by whom? NABARD. Fine. Next, moving on to the cooperative banks. So, under the cooperative banks, we have 2 subheadings. First one is the rural and the next one is the urban cooperative banks. This rural cooperative banks is further divided into short-term structure and long-term structure. Under short-term structure, we have the state cooperative banks and under the same short-term structure, we have the district or central cooperative banks. Next, the third subdivision is the primary agricultural credit societies. Now, we are done with the short-term. Moving to the long-term credit structure. First one is the state cooperative agricultural and rural development banks. Next one is the primary cooperative agricultural and rural development banks. So these are the subdivisions under the cooperative banks. So the subdivisions of cooperative banks is very big. Please note this down. Next one, coming to the first term, that is the short term structure under the rural cooperative banks. Under the short term structure, it can lend credit up to 1 year. So up to 1 year means it is short term structure. So they lend for what activities? They lend for cultivational activities plus the input, that is the seeds, fertilizers. For example, take agriculture. The input cost of agriculture is the seeds. The fertilizers, pesticides, and for the irrigation, electricity, all these are inputs for the agriculture. So for this, the lending activities is carried by the short-term structures under the rural cooperative banks. Next one, it is a three-tiered setup. So under the short-term structure, under the rural cooperative bank, it is the three-tiered setup. First one is the state cooperative bank. Next one is a central or district cooperative bank. Third one is the primary agricultural credit societies, this one. Okay, so this is divided into three, I told, right? So this is a three-tiered structure. First, moving to the state cooperative bank. So we saw here, right, these three structures. So the state cooperative banks is the first one. So each state has its own cooperative bank. That is the state cooperative bank. Take Tamil Nadu. So Tamil Nadu will have one state cooperative bank. Take Kerala. Kerala will have one state cooperative bank. Like this, each state has one cooperative bank. So how this structure works out is, see, take RBI and take NABARD. So RBI is here, NABARD is here. NABARD is the bank for agricultural and rural development. Fine. So RBI and NABARD, between that there is an intermediary called the state cooperative bank. So this state cooperative bank acts as an intermediary between RBI and NABARD. Fine. So earlier this was an intermediary, now it is not considered to be an intermediary. Now take RBI. It gets loan from RBI at concessional rates, gives grant to cooperative banks in the state. So see, under the state cooperative banks, under this there will be various sub-state cooperative banks. So what the state cooperative banks will do, it will get loans from RBI at a concessional rate. I told you what is concessional rate. See, 10% interest to others, but only 5% interest to you means it is concessional rate. So it will get loans from RBI and give to the various state cooperative banks. Fine. Next, moving to the central cooperative bank. So under this structure, three-tier structure, we are done with state cooperative banks. Now moving to the central cooperative or district cooperative banks. So under this, it is operated at the district level. See, each district, we have Tamil Nadu state and we have districts inside Tamil Nadu. Each district will have one central or district cooperative bank. So under this, we have two more structures, that is the cooperative banking union and the mixed central cooperative bank. What is called as cooperative banking union? See, under this, the membership of the cooperative banking union is open only to the cooperative societies. See, inside a rural area, you will have various cooperative societies. Like you will have MSME, small and medium enterprises. You will have allied activities like poultry activities. You will have various raw material industry like beads industry, sari industry, all these. So all these are small enterprises, small cooperative societies. So only these societies can be members under the what? Under the cooperative banking union. Fine. So next, coming to the membership of the mixed central cooperative banks, that is this second structure, mixed central cooperative banks. So under this, the membership is open to both, that is the cooperative societies and the individuals. See, if I am staying inside a village, if I am not a member of the cooperative societies and I am an individual person, so I am planning to set up a business. Fine. So I am approaching what? I am approaching the mixed central cooperative banks for loans. So I can be a member of what? Mixed central cooperative banks and not a member of cooperative banking union. Fine. So normally what the state cooperative banks will do, it will lend loans to the central or district cooperative banks. What the central or district cooperative banks will do is, it will lend loan to the primary agricultural credit societies. We saw here, right? Primary agricultural credit society. So loans from here will go here and loans from here will go here. So this is the structure of the cooperative banks. This loan will be got from RBI. So RBI will lend loan to state cooperative banks. State cooperative banks will lend to district or central cooperative banks. District or central cooperative banks will lend to the primary agricultural credit societies. And then finally it will go to the individuals also. So individuals also will get loan from where? The central cooperative banks. Next, they operate at village level. Very important. This primary agricultural credit societies, they will operate at the village level, because already we saw at the state, then we saw at the district, now we are seeing at the village. Fine. So the primary agricultural credit societies works at the village level. So it lends short-term loan to agriculture. So who are involved in the agricultural activities, it lends loan up to 1 year or up to 3 years for the individuals. Fine. So this is the operation of primary agricultural credit society. Now we are done with short-term structure. Now we are moving to the long-term structure. So under the long-term structure, it is like it lends medium to long-term loans. That is from 1.5 to 25 years it will lend loans. So for what all activities does this long-term structures help? That is for the land development, for the construction of well, for setting up the pump sets. So for all these activities, the long-term structure loans are being lent. Initially, this was called as mortgage banks. So under the long-term structures, you have different kinds of banks, right? I'll let you all know. That's called as mortgage banks, or later it was called as the land development banks, because it was lending loan for what? Land development. And later, finally, it is now called as what? Cooperative Agricultural and Rural Development Banks. It is now called as Cooperative Agricultural and Rural Development Banks, and it is being set up at the state level and the primary level. So this is all about the cooperative banks, that is the short-term structure and the long-term structure. So we are done with the cooperative banks. So next, moving to the submarkets. It is a favorite area of UPSC. So listen to it carefully. First thing, under the submarket, we have various subdivisions. First thing is the call money. Next thing is the bill market. Bill market is divided into commercial bills and T-bills. After that, we have certificate of deposits or COD. Fine. Next, lastly, we have the commercial papers. First thing, the call money market. So this is called as the call money market. We'll deal with it. So under the call money market, it is the money at call and short notice. Very important thing, it is the money at call or short notice. Fine. It ranges from 1 to 14 days. See, for example, bank 1 and bank 2. Bank 1 is in need of money, so it asks from bank 2. So bank 2 lends the money to bank 1. So this is called as the call money market. So the transactions between bank 1 and bank 2 is called as the call money market at short notice. Fine. It ranges from 1 to 14 days, and the call money market is divided into two more subheadings. One is the call market, next one is the short notice market. What is called as call market? Call market is nothing but bank 1 will lend from bank 2 for only 1 day. So for only 1 day, bank 1 is lending from bank 2. That is called as call market. And it will return back the borrowed money to bank 2 within 1 day. Under the short notice market, up to 14 days, bank 1 will lend money from bank 2 for 14 days. So within 40 days, it will return back the money which it borrowed from bank 2. So that is called the short notice market. This is very important because it was asked in Prelims 2020. Fine. We've done with call market. So I'll repeat it again. It is a transaction between bank 1 and bank 2. So there are two types. If it borrows for 1 day, it is called as call market. If it borrows up to 14 days, it is called a short notice market. Fine. Next, moving to the bill market. Bill market is divided into two, that is the commercial bills and the T-bills. I'll let you all know about the commercial bills. See, bill market is also short term. Very important thing to be noted down is, for the prelims, you should note down whether it is long term or short term. For everywhere, every subheadings, note it down whether it is a long term fund or a short term fund. Fine. So this bill market is also short term, like the call money market. Fine. So under this, the short term funds are lent up to 90 days. So how much it is lent to? Up to 90 days. The bills are bought and sold. It is bought as well as sold. So the term is 19 days. Over here, call money market, you should remember 1 to 14. Over here, you should remember as 90 days. See, under this, again, this is divided into two. First thing is the commercial bill market. Next one is the T-bill market. So under the commercial bill market, you have the industries. See, we have the industries, we have the traders. They issue the what? Commercial bill. They issue the commercial bill. For example, see, in case if I am setting up an industry, so I need money. So for that, I am issuing commercial bills. I'll issue commercial bills and get money from the market. So that is called as what? Commercial bill market. Not only the industries, even the traders will issue commercial bill. So all these people come under the commercial bill market. What is T-bill market? T-bill market is nothing. We already dealt with this. I'll just revise it for you all. So it is a zero interest or zero coupon bond. That is called as T-bill market. So under this, see, if the T-bill is issued at ₹100, I can pay ₹90 and get the T-bill. And later, there will be a maturity period for this T-bill, right? On that day, they will give me ₹100. So it is redeemed at the par value. So I'll repeat it again. See, if there is a T-bill here, I'll give only ₹90 and get it. But while receiving the money back, I'll receive ₹100. So this is called as redeem at par value. They will not give you interest. So there is no interest for this T-bill. Fine. No. See, for example, for ₹100, 5% interest means while receiving back the money, I'll get 105 rupees. But this T-bill is not like that. At earlier rate, the money which you are giving itself is 90 rupees only. But when you are receiving the money, it will be 100 rupees. So that is what is called as redeemed at par value, written value. Fine. Next thing, under this T-bill market, you can divide it into two more subheading. That is the ad hoc T-bill and the regular T-bill. So now we don't have ad hoc T-bill. It was being abolished by the government. So we'll know about the ad hoc T-bill. Fine. Ad hoc means something that is not permanent, that is temporary. Fine. So this ad hoc T-bill 1991-1992 T-bill of 91 days was introduced. So 1991-1992 T-bills, treasury bills of 91 days only was there. Fine. And after in 1997-1998 it got discontinued. This 91 day T-bill got discontinued and ways and means advances was replaced instead of this ad hoc T-bill. See, get to know this point. Earlier, there was ad hoc T-bill. T-bills are issued only by the central government and not by the state government. I told you all already. Over here, 1991-1992, we had only 91 day T-bill. So, the government, central government was able to borrow up to 91 days only using this ad hoc T-bill. But what happened was, 1997-1998, this 91 day T-bill got discontinued. Why? See, because it was ad hoc in nature. Ad hoc means it is temporary. Only for 91 days it should be issued. So what the central government did, so it started using this ad hoc bill continuously. Fine. So that's why this ad hoc T-bills was discontinued and replaced by ways and means advances. We already dealt with ways and means advances, that is RBI will lend money to whom? The central government and state governments for a short period of time. That is called as ways and means advances. Now coming to the regular T-bill. What is called as the regular T-bill? See, regular T-bills are issued to meet the budget expenses. For example, we have the budget 2020-2021. Fine. So under this, we have various schemes and policies. So to meet this budgetary expenses, the government borrows with the help of T-bills from the market. Fine. So earlier we had 182 T-bills and later it was replaced by 364 day T-bills. Later again 182 days T-bills was bought in. Now we have 14 day T-bills also. So the treasury bills are of various kinds, 14 days, 364 days, 182 days. So keep all these bills in mind. Next, coming to the dated government securities. So all this what we saw now was short term funds. Now we are going to see the long term maturity funds. So dated government securities are a kind of bonds. For example, see. So they have a long-term maturity. For example, take Government of India. Government of India will need money, right? Same like us, we are approaching banks, right? Same way Government of India will need money. For that, it will sell the dated securities. It will have these kind of bonds. These bonds are called as dated securities because it will have a maturity period. That's why it is called as dated. Fine. So it will sell the dated securities to the market. By what? By auction. See, over here you have Government of India. Fine. You have many people over here, person 1, person 2, person 3, person 4. This is called as auction. It has the dated security with itself. So, Government of India needs money. For that it is selling what? It is selling the dated securities. So, what the Government of India is expecting is, whoever is pegging at higher interest rate for him, the Government of India will give the dated securities. Fine. So that is called as auction. So normally the Government of India needs money. So hence it sells the dated securities through auctioning. Fine. And the dated security maturity date is 5 years, 10 years and it goes up to 30 years. So up to 30 years the Government of India will use the money which it borrowed from the market. Fine. So we have the various dated securities. Please keep this in mind. Next one, coming to the certificate of deposits. Very important, Prelims 2020. So what is called as certificate of deposits? It is issued by the commercial banks and the finance institutions. Fine. You know what is a commercial bank? What is a financial institutions? Same way like the commercial bank, financial institutions will also do the lending, borrowing activities. So those other than the banks, those are doing banking activities but not banks are called as financial institutions. Fine. So under this, they need additional funds. Fine. Who? The commercial banks and the financial institutions need additional funds from the market. So these people, they issue certificate of deposits. Fine. They are issued in multiples of 25 lakhs up to 1 crore. So up to 1 crore, this certificate of deposits will be issued. And the maturity period ranges from 3 months to 1 year for the banks. If the banks are borrowing money from the market, they should pay within 3 months to 1 year if they are issuing certificate of deposits. In case of financial institutions, if they are borrowing money from the market through certificate of deposits, they should repay it back within 1 year to 3 years. So this is the maturity period for financial institution. This is the maturity period for banks. So these are the two kinds of maturity period. Please keep in mind, both are not the same. For banks it is different, for financial institutions it is different. Next, coming to commercial papers, Prelims 2020, it was reflected under 4 statements, all these short-term loans. See, it was introduced in 1990. Commercial papers was introduced in 1990. So it is issued by whom? It is issued by corporates. So commercial papers, commercial means corporates. So the corporates issue commercial papers at the denomination of 5 lakhs or its multiples. So at the denomination of what? 5 lakhs or its multiples, it issues the commercial papers to a minimum amount of 1 crore. So the minimum amount which you can invest in the commercial paper is 1 crore. Next, the maturity period. Everything has a maturity period. So commercial papers also have maturity period. It is a short term. Keep in mind, it is short term. That is why the maturity period is from 3 months up to 6 months. So maturity period of commercial papers is from 3 months up to 6 months. Next, moving to the unorganized sector. So we've dealt with all the organized sectors. Now moving to the unorganized sector. What is called as an unorganized sector? So it is not registered plus regulated. See, all the organized sectors will be regulated by RBI. Over here, this won't be registered also. It won't be regulated also by anyone. No proper account. See, banks will maintain a ledger, right? So under the ledger, it will have the assets and liabilities. Fine. But under the unorganized sector, there is no proper accounts. There are 2 kinds of unorganized sector. One is the money lenders. Next one is the merchant cum money lenders. So now, who are the money lenders? Money lenders, the basic activity for them itself is money lending. So that is the source of livelihood for them. Fine. See, a money lender will be like, he will lend money of 100 rupees to one person, 200 rupees to another person, 300 rupees to another person, like this. His source of livelihood depends upon the lending of money from the interest he earned. Fine. Next, coming to the merchant cum money lender. So under this, see, if I am having a production unit, I don't have money for my production unit. Fine. I will approach a money lender. So what is the agreement between me and him will be, he will tell me the products has to be sold only to him. Fine. So at the initial stages, until paying the money back to him, what and all products I produce under my production unit, I should sell only to him, that too at a lesser rate. See, normally the market value of my product will be 30 rupees, but I should sell my product to him at 20 rupees. So this is called as merchant cum money lender. Next, coming to the banking scheme, the first scheme is the lead bank scheme. Under this scheme, a district is selected. Under that, there will be various kinds of bank. One bank will be selected and that bank will be made as the lead bank. So under this lead bank will coordinate activities of all other banks. So one district will have many banks, right? Take around 20 to 25 banks. So this lead bank, this one bank will be the head of all other banks and it will see to the activities of the all other banks. Next, it will see to that the same person does not get loan from all the banks, from many banks. Fine. And so it sees to that all sections of the society are into the banking system. That is, all sections of the society gets loan. Next one, service area approach. This service area approach comes under the lead bank scheme. So under this, it was brought in 1988 under the lead bank scheme. See, the semi-urban areas and the rural branches of the banks sees to that the banking system reaches the maximum amount of people. That is called as service area approach. So next, coming to differential rate of interest scheme, which was introduced in 1972. So under this, a public sector bank, note it down, a public sector bank should grant 1% of its total deposits of the previous year. See, for previous year, if the bank's deposits was 100 rupees, 1 rupee it has to donate to the differential rate of interest scheme. How is this happening is, see, this 1% it should lend to the weaker sections at concessional rate of 4%. See, if to others the bank is lending at 10%, for them it should lend this 100 rupees only at 4%. So this is called as the concessional rate. Fine. You have to keep in mind the grant of 1% of the total deposits of the previous year. So this is the differential rate of interest scheme. Next, 40% of the loan should be given to SC or ST people is compulsory. So under the 100% loan they are lending to people or various other institutions, 40% of this should be lent to SC or ST. Next, coming to the social banking. So under the social banking, it is the financing. The banks will finance to various poverty reduction programs and employment programs. So to under these two subheadings, if the bank is lending loans, that is called as social banking. Next, coming to the priority sector lending, very important for prelims. So you can update this in your current affairs. Fine. I'll tell only the static part and the example for this. See, under the priority sector lending, this priority sectors contribute to the national income at large, okay, but get less credit from the banking sector. For example, see this agriculture, this micro, small and medium enterprises, they contribute to the national income by giving a large amount of employment opportunities. Fine. But these sectors are getting a low credit from the banking sectors. They are getting very low loan opportunities from the banking. So this priority sector lending, that is the priority sector list, is created by the RBI. Who all will come under the priority sector will be enlisted by the RBI. That will be decided by whom? RBI. Next, see, for priority sector, each kind of bank and institutions has certain kind of priority sector, certain percentage. Fine. So 40% of the adjusted net balance or off-balance sheet exposure is credited by the domestic scheduled commercial banks. See, if in your area, if you have a domestic scheduled commercial bank, 40% of the adjusted net bank or off-balance sheet exposure is given to the priority sector. For example, see, the domestic scheduled commercial banks should lend 18% to agriculture, 10% to weaker section, and 8% target for the small plus medium farmers, 7.5% to the micro enterprises. So this percentage will vary from time to time. Fine. Next, the priority sector lending, that is the RRB, should lend up to 60%. So priority sector lending for RRB is 60%. For the domestic scheduled commercial banks, it is 40%. So for banks, foreign banks which has more than 20 branches, the priority sector lending is decided. So for example, see, for the foreign banks which has less than 20 branches, it has to give credit export or export credit of 32%. For example, if I'm having an exporting company, if I go ask the foreign bank for loan, that foreign bank has to lend up to 32% to these priority sector lending, that is the export credit. So like me, various other people will go approach the foreign bank. So he has to set aside 32% and give that amount to the export credit. Next, coming to National Housing Bank, that bank will lend to the housing activities, and SIDBI, Small Industries Development Bank of India, will lend to small industries. So this is called as the priority sector lending of the banks. Fine. So we'll deal about the adjusted net bank and the off-balance sheet exposure. Fine. So we've done with some of the topics related to Indian financial system. Let's deal with the remaining topics in our next video. Thank you for watching, and please subscribe to Get Into IAS and join our Telegram link in the description box given below. Thank you.